Joined right now by Sean McCarthy, CEO at Build America Mutual. Sean, thanks so much for joining us. Thanks so much for putting us up in your building here.
Jen and Paul, it's really great to have you here. We're thrilled to be the host.
One of the big stories today, Charlie Munger passing. Any experiences, any thoughts there? You've been in this business a long time.
Charlie Munger was one of the great credit thinkers, really in the history of credit thinking. Last night, I actually reread an essay that he wrote when he was in his late 60s and then rewrote when he was 81. It's called The Psychology of Human Misjudgment. He essentially articulates 25 ways that people convince themselves to make the wrong decision. It's excellent. I recommend. I'm sure you can get it right online, but I mean, it shows how brilliant an individual he was.
Yeah, absolutely. Yeah, but the stories we're seeing in the reporting today is really, I think, bringing that to life for a lot of people. All right, Build America Mutual here. Tell us about your business. Tell us about, really, explain to our listeners kind of really what you do, how you guys are integrated into the municipal bond market in this country.
Sure. So Build America Mutual is an insurance company that guarantees municipal bonds. And so essentially what we do is we act like a parent. If you have your kids and they get a student loan and you need to co-sign for that student loan, you want them to get a job and pay it back. Our job is if they fail to make that particular payment, that we make that payment for them. So our job is to sort of make bonds more secure by being AA rated, or we're AA rated by Standard & Poor's. And in doing that, we create greater stability in the market for the bonds, less volatility in terms of how they fluctuate. And we provide credit diligence, which we share for free on our website. They're called credit profiles, a description of each deal that we underwrite, and we update that annually. And it's just available as a service because we're a mutual insurance company.
I love that analogy, the parents of the bond market, keeping all the kids in line. But now let me ask you, what's the demand for insurance in this particular type of market?
So it's so if you think about what the insurable market would be, it's not before the Great Recession. Municipal bonds were guaranteed up to about 60% of the total market, which would have been about over 80% of what could be insurable. So if you look at the market as a whole and you think that, AAA bonds won't use bond insurance, and there are certain credits that are non-investment grade or outside of the underwriting appetite of ourselves or the industry, what's left in the middle are insurable transactions, and in that area, about 25% of the bonds are insured. So that's quite a big growth. It's about a 30% growth since COVID started in terms of how much market penetration there is. And
so has that changed pre-COVID to post-COVID?
Yes, it has.
So investors demand more insurance, more guarantees, more stability now?
They're using bond insurance more than they did before. And so there's a number of things that bond insurance really does. It provides, not only is it providing the default protection, which I described as you standing behind your children and their student loans, but it also provides a stability in the market, and it provides a security so that you may not have the time to understand small or complex credits. We're guaranteeing them, and then essentially what that means is we're promising to pay timely payment of principal and interest on that bond when it's due. So there's different than other forms of insurance, which once you file a claim, then there's a negotiation. We pay immediately, and then we mitigate later, which is one of the strengths and why individual investors can count on the strength of a financial guarantee.
Can you give us a sense of what the sentiment is that you're experiencing in this market? And it's kind of like a pre- and post-COVID question.
Yeah.
But also, is there some key lesson about investor psychology, as we started off talking about at the beginning of this segment, that you'd want to say that you've noticed?
So I'd say two things. One is interest rates have gone up a lot. So the primary market, meaning the overall volume in the market for new issue, has been lower for the last 2 or 3 years. That being said, the new money portion, the portion of the market that is just building new projects, new schools, new roads, this year will be its second highest year ever. 2022 was the highest. But there are no more refinancings. If you just think about it, with interest rates going up, the concept of saving money by refinancing that bond has gone away. And that was about a third of the market historically. So that's one thing. But if you look at the sentiment in the market overall, a good example would be this last election in 2023. There were 70% of all bond issues that were on the ballot were approved. So that was $60 billion worth of new transactions that are going to come to the market just from the 2023 elections. So now we look at the credits generally and we think to ourselves, two things have happened since COVID. One is the federal government stepped in and gave an awful lot of money to all kinds of communities. And some of that money still is being spent by them. It sort of explains in one way why the bipartisan infrastructure bill has not actually been drawn on a lot, because the really most municipalities survived well through that crisis of the pandemic. And part of that was that they went into the pandemic being strong. I mean, so you think 3 or 4 years ago, there was lots of, all the coffers were filled at most municipalities. So now what we're looking at is to see what happens as the rest of the money that they've been given runs out, and what is the real environment for what's going to happen to municipal credits going forward in terms of an operational standpoint.
Who decides whether a bond is insured? Is it the issuer, the underwriter? Who decides that?
So nobody uses us unless we save them money.
Okay.
So when you're issuing your bond, the underwriters on the desk, first the financial advisors who advise the municipalities will say you should consider bond insurance. We'll underwrite the transactions. As the time comes to bring the deal to market, they'll look at it and say, well, how much is BAM charging, and how much are we going to save as a municipality? So that's really the decision that's made right at the time in the market. So when markets are more volatile, bond insurance is used more. When markets are more stable and people have the time, or when volumes are lower, they have more time to take a look at the credits and may say, I'll just take that bond without the insurance.
It's interesting because one thing I'm wondering is about how the election next year, the U.S. presidential election, is going to impact demand for this kind of insurance. I mean, already we're expecting maybe some market volatility with the Fed shifting direction, but how does the election figure into that?
So two things to remember. First of all, people look to the federal government's role in infrastructure, and it's the big stuff. So it's I-95 and the Hoover Dam and big things that are done at a federal level. But 80-90% of what you think of as infrastructure is done at the state and local governmental level. So these things are issued by towns and cities, and that's really the fundamental component. So if you look at what's going to happen in the election next year, it's really a function that resides at the state and local governmental level in terms of how the markets are going to move. And what happens to interest rates overall will affect volume and whether there's a prospect of refinancing as interest rates start to decline, as our prior speaker was advocating.
But I've been told by municipal bond folks that municipalities issue when they need to, not when the market's great. So I mean,
that's true. So think about what's happened. They have a lot of money. Volume's been down because they haven't had to issue. But remember, there's this whole incredibly pent-up demand for rebuilding and creating new projects. And so the things to really watch for, if I was an investor on the other side, is to say, okay, what's going to happen to interest? What does high interest rates do to municipalities? Well, what does it do to mortgage rates?
Yep.
What does it then do to commercial real estate values? What does it do to residential mortgage values? Those are some of the key underpinning issues that move credits good, bad, or indifferent.
Okay.